What's up, agency owners? Jason Swenk here with another episode of the Smart Agency Masterclass, a podcast dedicated to you, the digital agency owner that wants to grow and scale faster while creating the freedom where you can pick and choose and do the things that you really love doing and get rid of the shit you don't like to do anymore. On today's episode, I have a great guest. We're going to talk about what are the best KPIs for you to really track, to measure where you're at and what you actually need to be doing if some of the KPIs dip below where they shouldn't be. Because I find a lot of agency owners are not measuring this, and it makes it harder. So we want to make it easier for you. So let's go ahead and jump into the episode. Hey, Jon, welcome to the show.
Hey, Jason, thanks for having me. Good to see you.
Yeah, so tell us who you are and tell us a little bit about your background.
Sure. So, Jon Morris, I am CEO of Ramsay Innovations. But prior to founding this company, which I founded in 2020, I started in 2004 working out of my home an agency called Rise Interactive. Bootstrapped it for 12 years before I took minority investment from a company called Quad Graphics, and then took majority investment from them in 2018 and grew it to one of the largest independent digital agencies with about 250 employees and managing about 250 million in media before I sold.
Awesome. And why did you start an agency?
So I honestly did not want to start an agency. I was at University of Chicago for business school, and they had a business plan competition. And my background was digital marketing. And I came up with the idea of teaching small businesses how to do digital marketing themselves. But really, all I wanted to do was win the competition. And I ended up taking second place in the competition. I won $10,000, which was my seed money. And I just kept on thinking of like all these really smart venture capitalists and private equity people and entrepreneurs believed in my business model. Maybe I should give it a shot. And so I was putting on 2-day seminars. And as I was putting on these 2-day seminars, the people in the audience kept on asking me, could you just do this for us? This seems hard. And I decided that was a better business model. And so I pivoted the business model and started an agency.
And I guess my next question, because you said you took a minority investment and then a majority investment, walk us through the thinking of those two things. Like, why did you take on an investment? Like, where were you at in the agency and where did you think you could actually go?
Sure. So bootstrap the organization. I'm guessing our fees are probably around 20 million or so when I took the minority investment. And there's a couple things. The first thing is I wanted to invest more in sales and marketing, and I wanted to invest in technology. And, I always said that our vision at Rise was to be the leaders in leveraging data to help brands make smarter marketing decisions, which is a very, very fancy way of saying we're data-driven. But the reality is that if you line up 50 other digital agencies, they're all going to say they're data-driven. So the question is, why are you more data-driven than someone else? And even the word data is an interesting word because are you talking about customer data, competitive data, pricing data, inventory data? We went all in on media data. And I would say to this day, I still think that Rise manages media data in terms of identifying waste and redeploying that waste to areas that are scalable better than anybody because of the technology we built. And so the reality is that there just was not enough capital for me to do all of those sales, marketing, and technology investments without outside capital. And so that's why I went to the capital markets.
Gotcha. And just to clear it up, because a lot of people may be a little bit confused, when you were saying you were 20 million in fees, that's with media spend, right?
No, that is not with media spend. So
20 million wasn't enough?
So when you think about building technology, just today, I believe Rise's product development team is 55 people. So if you think about trying to build technology and having enough velocity to actually put together a sizable team, and if you think about how much engineers cost, it's a major investment. And so if you think of a typical agency supposed to generate, let's just say 4 million out of 20 million in EBITDA, well, our strategy was to invest that back into the business as opposed to take it back out. But we
Okay.
were looking to spend more than that $4 million
Gotcha.
between sales and marketing. The strategy has worked, in the sense that the agency has continued to scale quite considerably.
And do you feel that once you go, well, let me change the question. I presume when you took on the investment, you probably had a separate team and someone in charge of that rather than kind of sharing resources with people that work on agency services. Is that correct to assume?
Yes. So the way I look at it is every business or every agency has a very standard leadership structure. You have a client service team, which is what I consider the people who actually take care of the clients. You have a sales and marketing team, which might be a head of sales and a head of marketing, or it might be one person who runs the whole group. Then you have operations and finance, and that is HR, finance, legal, admin, corporate IT. And then in our case, we added another pillar, which is product development and actually building technology.
Gotcha. Yeah, I only ask because I remember when we were building tons of technology at the agency. We never took on any investment, but the reason why you don't look at me for building technology is because we failed at it. We didn't take on any investment. We shared resources, and when the clients were needed help and work, we put all the resources on them versus our technology, which hurt us because we were one of the first to do an e-commerce store, email
Yeah.
marketing system, a CMS. Like I look back, I'm like, oh my gosh, like the opportunities missed were like in the bees.
Yeah.
It was crazy how much we missed. But I just thought that was an interesting direction to take it for a second. But why people are
So
here?
let me just
Yeah, go
add
for it.
one point, and then we'll get into the heart of it. When you build technology, the trick and the reason why service-oriented companies generally aren't good at building technology is that you're thinking like, oh, I'll have this person who's selling or working on a client will do this on the side as well. And what you need is a fully dedicated team. So you have UX people, engineers, product people, DevOps, QA, all forming a team, and they eat, sleep, and breathe this specific product. And that's one of the reasons why we had to raise capital is, you're building a substantial team to build all that functionality out.
Yeah, totally agree with that. So let's talk about the KPIs. What are the most important KPIs and why to an agency?
So the first, in my opinion, the most important KPI is gross margin. And I'm going to explain how I calculate gross margin because you're going to hear a lot about adjusted gross margin or adjusted gross income. And it is a very different metric. So the first thing that you need to do to get to your gross margin is you need to know what your revenue is. And I break up revenue into two categories. The first is gross revenue, and the second is net revenue. So you asked me before, was 20 million inclusive of media, right? And the answer is I said no. So what I'm saying is that my net revenue was 20 million. Our gross revenue was probably about 100 million at that point in time. There was probably $80 million in media that was being allocated and then 20 million in fees. So that's the first thing. And by the way, I've now worked with dozens of agencies and seen the financials of hundreds of agencies. That's not as easy to get to as a number as people think. Oftentimes their invoices are bundled and you have to unbundle it. And so just getting the data clean to figure out what's your net revenue versus gross revenue is hard. The second thing you need to do is you'll see a lot of companies where they'll focus on like payroll divided by revenue as a ratio. But that payroll generally includes everything. It includes your sales and marketing, it includes your operations. And what we want to do is get to what we call your cost of service. In order to get to your cost of service, we go through every single line item to determine, does this individual or does this piece of technology, is it dedicated to client work? So if you have an employee that is dedicated to a client's paid search campaign, well, then that's going to be in cost of service. If you have an employee that's dedicated to HR, that is not going to be in cost of service. Now, what we are looking for is to get clients to a 50% gross margin. On average, when you take all of our clients in aggregate, they're at 48%. When they started with us, they were at around 40%. So there's generally been about a 20% improvement in gross margin. So I'm going to explain why this is, in my opinion, the most important KPI out of any KPI that you can look at. Is if you think about, if anyone ever watches Shark Tank and they'll ask them, I was like, well, what's the gross margin? I was like, well, this product comes in landed at $3 and I sell it at 20 and it's got 85% gross margin. Well, it's no different for the services we sell. If you are selling something for $1 million and you get 500,000 in fees and then 500,000 in gross margin, that means you now have $500,000 that you can go invest in your business or put in your pocket. But if that same $1 million, it costs you $800,000, well, now you only have $200,000 to invest in your business or put in your pocket. And, one of my favorite examples is I had 2 clients doing the exact same thing with the exact same market, with the exact same type of client, both around 5 million in net revenue. One made a profit of $1.5 million. One lost a few $100,000. The difference was their gross margin. Now, when I was at Rise, just to give you an idea, we were on the Inc. 500, 5,000 for 9 years in a row. The only reason why I wasn't 10 was that I sold to a publicly traded company and I was no longer eligible. And part of the reason why is this obsession with constantly improving your gross margin. When we talked about building the technology, I would look at the hours of every single task that we were doing to figure out what we could automate so that we could improve our gross margin. Now, the next metric that I find incredibly important is what percent of your revenue do you spend on sales and marketing? And going back to, you want to divide your payroll so that if you have any salespeople, any marketing people, that all gets grouped into your sales and marketing cost. And it's a real simple rule. Doesn't mean you're going to spend your money intelligently. But if you spend sales and marketing, you have a better chance of growing than if you don't spend money in sales and marketing. And so I really look at that ratio, and I have a general rule that I follow. The first is that if you spend between 0 and 5% of your revenue on sales and marketing, you're not that serious about growth. If you spend between 5 to 10% of your revenue on sales and marketing, you're about where everyone else is in terms of how important growth is to you. And if you spend 10% plus, you're very serious about growth. And by the way, it is okay if you're not serious about growth. I have a client of ours right now whose sole focus is really just increasing their revenue per employee. And they're like, we want to grow moderately, but we just care much more about I love my life. I love my lifestyle. I would just like to optimize this and figure out how do I improve the gross margin so that I can add more profit to my pocket. That's awesome.
Yeah, I always looked at it as I'm going to spend 10% on marketing out of the top line revenue or gross revenue, right? And then 20%
gross or net revenue?
Gross.
Okay.
And then 20% of that is going to go to sales with, the VP of sales, sales team, all the different sales, all that kind of stuff. So we were spending around 30% when we were in high growth rate. So yeah. we were pretty serious.
And it explains why you had such a great exit, It was really funny because I can't tell you how many people came into me and was like, oh, well, we don't spend any money on sales and marketing, or we don't have any salespeople. And my response was like, how come I'm the only marketing person that believes in marketing? You think about what we all do for a living is help brands grow through marketing. And yet we don't do any of the investments ourselves.
Well, yeah, it's kind of the cobbler's kids. I mean, I have a
Yeah.
lot of social media agencies in the mastermind that hate social media.
Uh-huh.
They won't admit it. I mean, they won't admit it
Yeah.
on camera, but they'll be like, "Oh,
Yeah.
I hate it when I sell this fucker. I'm not,
Yeah.
like I'm deleting all my
Okay.
accounts."
Yeah.
So
So
what are some other what about EBITDA? How important is EBITDA as a KPI?
so it's an interesting number. So I'm going to tell you kind of like the golden rule of agencies. 20% top line growth, 20% EBITDA. So if you're to sell to a holding company, they want you to have 20% EBITDA. I have a different philosophy as it relates to EBITDA. I like agency owners to think of themselves as private equity people. And if you have a positive investment that you can make in your business, I'm okay with you having a lower EBITDA number, but then you got to see it come into your gross margin or your top line revenue growth. There were multiple times, where it took me a while to figure it out. So, like, we got to seven figures in sales and marketing really quickly. And our EBITDA was great. Our growth rate was great. Couldn't have been happier. I doubled it. Guess what? I brought in the exact same amount of new business when I doubled it than I did with my first million. So what that told me was the incremental benefit of that second $1 million wasn't what I thought it would be. Now, what did I do? I kept the $2 million budget, but I then fine tuned the program so that I could get more output. Just to give you an idea of some of the revenues, I went from 1 million to 2, 2 to 4, 4 to 8, 8 to 12, 12 to 13, 13 to 19, and then it just started scaling from there in pretty significant ways. So EBITDA, is a huge, really important number, but it is okay if you can go hire a salesperson that's going to bring in a customer that's a retained relationship at a really good dollar amount. I'm okay with you making that investment. I'm okay with you investing in three of them. I'm okay with you investing in five of them, provided that we really measure the outcome in the percentages that you're looking at.
And I'm glad you said that because I always tell our members and agency owners, look, yes, if you're getting ready to sell, EBITDA is a very important number because
Yeah.
that's how a lot of people will do evaluation on most of the people the rates. When you
Yeah.
get up to the high ones, it's a little bit different. But for most of the people listening, for if your EBITDA is from a million to 10 million, right? Like it's usually an
Yeah.
easy multiple to calculate. But like you said, that's kind of when you're getting closer to exiting. But you can always invest. Like I have some members, we make them fill out KPIs every quarter. And some are like, man, it dipped way down. I'm like, well, why? And they're like, well, we invested
Yeah.
in it. Perfect. That's great. Like
Yeah.
you're the best investment you can actually do outside of anything else. So go ahead and do it.
Yeah. And I mean, I'll just give you an example. In this current business, I've invested personally. So I never really explained what Ramsay Innovations does. We are 100% dedicated to helping agencies get greater insights out of their finances so they can grow at a faster rate or achieve their financial dreams. And we do that through investing in their financial infrastructure, helping them with their accounting, but most importantly, the financial planning and analysis, where we get them in budgeting and forecasting and margin analysis and all these really important things that I believe was a huge reason why Rise was able to grow was the infrastructure we built in that what is called FP&A or financial planning and analysis group at Rise. And so the reason why I bring that up is I actually am not focused on EBITDA at all with this business. I believe that this business is a huge opportunity. I'm just focused right now on top line revenue growth. And I'm very focused on cash management. And those are the two really critical things that are important to me at this stage. And I agree with you. When you're ready to sell, you got to maximize your EBITDA. And you then want to think about that 20% number and what do you need to do to get there and what are your creativity. But in the meantime, it all depends on what your goals are. If you want to build a big company and you don't want to go to outside capital, lowering your EBITDA target will give you more money to invest in the business.
What about how much of cash flow do you think is healthy for an agency to maintain if everything stopped coming in? How many months of cash flow?
So I'm going to give you my rule. I believe that everyone should have two bank accounts at a minimum and three if you manage media. So the first bank account is what I'm going to call your operating account. This is the one that you use to pay your employees. It's the one you use to pay your taxes, and it's the one that you use to pay your bills. I want you to have 1 month's payroll and 35% of your quarterly profits in there at every single given moment. And that's the minimum you should have in your balance. But at the same time, I only want, one payroll cycle to be the maximum you would have in that group. So you're having a fluctuation, but that is giving you more than enough money to pay all of your bills at a given moment in time.
So you're constantly moving money into that, correct? Or
Ideally, you're
or is your client
ideally
money going into that as well?
ideally you're collecting your cash,
Mm-hmm.
and by the way, 99.9% of our clients, when they come to us, do not have a cash strategy and do not have enough cash, in my opinion. Uh, the second one is your savings account. What I want is your monthly overhead. So this is literally all of your expenses that go out the door, from your payroll to the tools you license to your sales and marketing to your travel and entertainment, like whatever that number is, times two. So 2 months is the minimum I want. However, I have rules where it might go up to 6 months. And those rules are the following. If you have one client or two clients that is the vast majority of your revenue, I want you to have more cash in case you lose one of those clients. I was talking to a potential client the other day. 90% of their revenue is one client.
Oh my gosh, that's so
Yeah.
stressful.
Uh, the second thing is if if you are project based versus reoccurring or retainer based, I want you to have more cash. If you um, if you have any capital improvements, like you're going to move into an office and you need to buy furniture, I want you to start saving up for that. You might have a partner that's different in age. I've seen this quite a bit where if someone who's in their 70s and a partner who's in their 30s, and the 70s person in the 70s is thinking about retirement and they want to get bought out. So those are factors that we bring into to help you think about your cash position. Um, and I'll give an example. I did a client strategy meeting just yesterday, and the person's cash position is not horrible and their business is very healthy, but we came up with an 18-month strategy for them to build up the cash to where I want it to be. So it doesn't have to be overnight, like, hey guys, you're below this mark, stop everything and you got to go lend money to the business. But it's, let's get you in a healthy position. It might take 6 months, it might take 18 months, but we want to build your cash to get you to where you need to be.
And what about the third account?
Third account is media. And that is what I want everybody to understand. That is not your money. You have a fiduciary responsibility to make sure that money is completely separated, that it's not run by you, that you don't use it as a line of credit so that if you have clients that aren't paying you, that you're using it to pay your employees. Think about it. This is the example I use all the time. Imagine if you you open an account in E-Trade and you put in a couple $100,000 and the CEO's like, I'm having a hard time in payroll. I think I'm going to go to Jason Swenk's account and borrow some to go make payroll this month. The guy would go to jail. And I look at it as media is the same thing. If your client gave you money to go spend on Google, you keep that completely separated. You know what their balance is at any given moment of time, and you make sure that you're never going to run into any issues there.
Yeah, I like that. Yeah, I mean, I think we have the same philosophy on a cash strategy. I was always like, if I had 3 months, I was good.
Yeah.
But we
Yeah.
had we had a wide diversity of clients. We never had a high concentration in one. So I do like that strategy of like, hey, if you have two or three clients, that's the majority, or probably any client that's over 30% in revenue, you probably should. It almost sounds like you might be a redneck if like that's kind of how I you
You
might
might
need to
be.
keep more cash
Yeah.
if this
And
scenario.
that actually, you talked about another really good KPI is looking at your revenue either by month or by year to date or 12 months trailing in terms of percent of each client. And what if you do a study where you're like, my top 5 clients represent what percent of my total revenue? I have a client, they have 123 customers. The top 18 represent half their revenue. Customer number 19 to customer 123 represent the other half of their revenue. And
It's crazy.
so there are 2 things to think about in that scenario. The first thing to think about is whenever I won a big account and it became a large percent of my revenue, I would increase my sales and marketing to go win my next big account. I was very scared about being dependent on any single customer. And so, really understanding customer concentration and then strategizing to reduce customer concentration is a crucial thing to do.
What's your thought on lines of credit as a backup, just to protect
You
you
know,
for the other? Because I always tell people get a line of credit when you don't need it, because you can't get it when
yeah.
you need it.
So it's funny. I post every day just like a different insight about finances for agencies on LinkedIn, and I just literally yesterday did a post about my philosophy on debt. So I absolutely believe that if you have a positive 12 months trailing EBITDA, that you should go secure a line of credit. But I do not believe that you should use that line of credit to fuel the growth of your business, but you can use that line of credit for cash management purposes. So, I'll give you an example. Procter and Gamble is known for paying on a net 120 days. That's their default, which I think is awful
I
for the
hate
record.
them. I hate you, Procter and Gamble.
Yeah. Um, but you know what? Like, if that's an account that you want and you can't negotiate better payment terms with them, then you might need a line of credit to make payroll, because they're a 7 or 8 figure account for you and you want to keep them, but you weren't able to negotiate better payment terms. So having a line of credit is really important to help in those scenarios. Where I don't want people to use debt, or I want them to be very careful about using debt, is if they want to invest to grow the business. So if they're like, I'm going to go hire 3 salespeople, and I'm going to go triple my business because I hired these salespeople, and then it turns out you hired 3 really bad salespeople, and the next thing you know, you got to pay interest on that debt, and you have to start paying principal, but you didn't get the growth that was supposed to come with it. You're in a lot of trouble. So I recommend being very conservative. And another ratio that you should be looking at is your debt to equity ratio. And I don't like it really to go above 2. I feel that when your debt to your equity is above 2, you're getting kind of into dangerous territory.
Yeah, you start making bad decisions. You're forced to
Yeah.
make decisions based on money, taking
Yeah.
on wrong clients, getting rid of the right
Yeah.
people. Like it's just, I've seen that. I was talking to a agency owner the other day, and they were like, the same scenario, kind of like the Procter and Gamble. Like we have some
Yeah.
clients that you know, are paying us at longer terms because they're a bigger
Yeah.
account, more people want it. And I was like, well, do you have a line of credit? Because she was stressing so much over the cash flow.
Yeah.
And I said, just use it temporarily. And like, I totally
Yeah.
agree with you. Do not use a line of credit for investments and that kind of stuff. It's like
Yeah.
literally just and here's the quick tip too, because we always got a line of credit, but they would always cancel it on us because we never used it. And
Yeah.
so what I would do every quarter is I would just take out like 10, 20,000 for a day, put it back in, pay like $10 and they would see
Yeah.
some activity, because if they don't see activity on it, because you're not paying anything to have a line of
Yeah.
credit unless you use it. So
And and then the other thing you need to do is like when you're measuring treasury, generally you'll give a line of credit and it'll be like for a 1 year or a 2 year term. And what you need to do is probably 4 months before that due date is, you have to start talking to your banker and say, what do I need to do to make sure that I preserve that line of credit? And I can tell you, just as small business owners and people owning agencies, and most of us got in this not because we knew anything about finances, but because we wanted to do really cool marketing stuff. That you need to put on your calendar the date that the line of credit will expire, and you need to put on the calendar 3 to 4 months prior to that to start talking to your banker, because otherwise, I promise you, you will forget about it if you're not using it.
Yeah, it's a good tip. In wrapping up, is there any other important KPI that you were looking at when you ran your agency?
Uh, yeah, I mean, I have a bunch that I was looking at, but I'll use this one, which is DSO, since we've been talking a lot about cash. DSO stands for days sales out, and it is basically the average amount of days it takes for you to collect your cash. And so, if you think about uh, the 45 is the number that I really want people to think about, meaning that if you send out an invoice and you have a DSO of 45, it takes 45 days for you to collect your cash from your customer. Anything higher than 45 as an average, I start to worry about in terms of your ability to collect your cash. And, you know, I really like to see it below 30, but 45 is a really good marker that you should all be thinking about in terms of managing your cash and making sure that you're doing a good job collecting it.
Yeah. Yeah. It's, I look at some books and their accounts receivables are enormous. And I'm like, wow, like, why are
Yeah,
these so like 90, 120 days, 200 days? I'm like, yeah,
it's
you're never going to
lending
see that
people money
stuff.
for
So,
free. And it takes
yeah.
training of the clients.
Oh, we used to send flowers or cookies to the
Yeah.
accounts payable people.
Yeah. It's a very smart move. Those people need to be your good friends.
Exactly. You see a
Yeah.
solar velocity invoice, put that on top.
Yeah.
Pay that one first. So, well, awesome, John. Well, thanks so much for coming on. Everybody, go make sure you check them out. They do a great service. And if you guys want to really scale and grow your agency faster and really be surrounded by amazing people where you can ask these types of questions, hey, how much cash flow do you have on hand? What KPIs are you looking at? What are you doing to create more freedom in your agency? I'd love to invite all of you to go check out digitalagencyelite.com, and maybe we'll have a conversation, and maybe you'll get to the place you want to get to a little bit quicker, and avoid some of the pain. You'll still go through some pain, but maybe you'll go through a little bit quicker and not as many scratches. So make sure you go to digitalagencyelite.com, and until next time, have a swank day.